Welcome to My Money, Your Investment channel, the place where smart investors turn information into opportunity. Today, we dive into the FY 2026 earnings summary and strategic overview of Lanka Milk Foods PLC. From financial performance and market positioning to future growth potential and shareholder value, we break down the numbers in a simple, practical, and investor-focused way. Is Lanka Milk Foods building a stronger future? Can this dairy giant continue its growth momentum in Sri Lanka's evolving economy? And most importantly, what does this mean for your investment portfolio? Stay tuned as we analyze the business, the strategy, the risks, and the hidden opportunities behind the headlines. This is My Money, Your Investment channel, where your money meets smarter investment decisions.
You are watching My Money, Your Investment channel.
Imagine a company sells over 14 billion rupees worth of milk in a single year. But its actual secret weapon, the thing generating billions in pure wealth, has absolutely nothing to do with cows or farms or dairy.
Yeah, it sounds like a riddle, right?
It really does.
Real.
But today, we are translating a dense 20-page corporate document into exactly that story. Welcome to the deep dive. We are unpacking the interim financial statements for Lanka Milk Foods PLC, specifically for the year ended March 31st, 2026.
Right, and the mission here is to synthesize these raw numbers into the actual mechanics of their business strategy. We want to show you the why and how behind the data.
Because honestly, reading financial statements is a literal superpower. It lets you see right past a company's marketing department to discover what they actually prioritize with their capital. And this deep dive is the perfect case study.
Oh, absolutely. This is a historic household brand. They were incorporated back in November 1981. And most people, they just associate them strictly with milk cartons.
Exactly, milk and dairy. But we're going to peel back the layers to see how they manage supply chains, why they act as a sort of pseudo-holding company, and how their capital allocation really dictates their true value.
Yeah, the math reveals a completely different reality than the branding.
Okay, let's unpack this top line, because I looked at their 2026 financials, and the jump in profit just immediately caught my attention.
It's hard to miss, honestly.
Right. So group revenue increased to 21.66 billion rupees, which is up from 18.94 billion the previous year.
Which, just to give context, is a solid 14% bump in revenue. Good, but not world-shattering.
Exactly. But then you look at their profit for the year, and it went from roughly 1 billion to 2.82 billion rupees.
Yeah.
And earnings per share practically tripled, going from 2.51 to 7.05 rupees. My first instinct when seeing a 14% revenue increase turn into a nearly 200% profit increase was they must have acquired a competitor.
Sold off a massive asset, right?
Yeah, exactly. But they didn't. A traditional dairy company suddenly tripling its profit. It feels like finding out your reliable old station wagon just won a drag race against a sports car. Is this just normal growth? Or is there a hidden turbocharger here?
Well, what you're hitting on is a classic concept, which is operational leverage.
Okay, break that down for me.
Sure. So a dairy company has incredibly high fixed costs. You have to build the processing facilities, you maintain these huge refrigeration networks, and operate the transport fleets.
And you pay for all of that no matter what, right?
Exactly. Regardless of whether you are running at 60% capacity or 90% capacity, the bill is the same. But once your revenue crosses the threshold that pays for all those fixed costs, every additional rupee of revenue drops almost entirely to the bottom line.
Oh, wow. So the margins just open up completely.
Yeah. Their gross profit, which is just revenue minus the direct cost of materials and labor, was 3.75 billion, up from 2.82 billion. The fact that they successfully protected that margin all the way down to the net profit level means they kept their administrative and distribution overhead tightly controlled while volume scaled.
That makes the analysis of how they achieved that volume so critical then. Because Lanka Milk Foods is not just, a single monolithic factory pumping out one product.
Right. It's a mix of distinct operations.
Yeah, 4 of them, according to the financial breakdown. And the performance gap between them is actually pretty severe.
It really is.
So the first segment is liquid milk and others. This covers UHT milk, the daily brand, Amboella Farm, fresh milk, yogurt, and fruit juice. This segment is the undisputed volume king.
Oh, absolutely.
It pulled in 14.63 billion rupees in revenue. But the profit on that massive 14 billion was only 843 million rupees.
Yeah, and that's because fresh dairy logistics are just brutal on margins.
That's because of the cold chain.
Exactly. You're dealing with highly perishable goods that require a continuous, unbroken cold chain from the processing plant directly to the supermarket shelf. The transport costs are high, the shelf life is short, and, spoilage rates have to be factored into the pricing.
So you're basically moving heavy, temperature-sensitive liquid all across the country.
Right. The revenue is massive because it's a high-frequency daily purchase for consumers. People always need milk, but the operational friction just eats away at the profitability.
Which is a crazy contrast to their second segment, which is powdered milk.
Yes, the margin king.
Yeah, this is the importing, packaging, and distribution of milk-allied products. The revenue here was just a fraction of the liquid milk side, only 5.68 billion rupees.
But look at the profit.
Right. The segment generated a profit of 1.54 billion. It made almost double the profit of the liquid milk segment while doing about a third of the sales volume. It's wild.
Well, the contrast in those business models is entirely about shelf stability. Powdered milk circumvents the cold chain entirely.
Oh, so you just don't have to deal with refrigerated trucks.
Exactly. You can import it in bulk, warehouse it at ambient temperatures for months, and distribute it using standard freight. The biological clock isn't ticking the moment it leaves the facility.
That makes total sense. So the overhead is drastically lower, allowing them to capture that massive margin premium.
Precisely.
But then we have the other two segments, and these are the ones dragging the overall picture down.
Right, the laggards.
Yeah. The third is trading, which handles the distribution of non-core brands. Talking Dano, Happy Cow Cheese, and Red Bull energy drink. Revenue there plummeted from 2.43 billion last year to just 777 million this year.
A massive drop.
Yeah, and profit basically vanished, down to a mere 64 million. And then the fourth segment is agriculture, the actual rearing of cattle and development of subsidiary farms.
And that one is actively losing money.
Exactly. It operated at a loss of 142 million rupees. Now, to be fair, that is a marked improvement from the 625 million rupee loss they took in agriculture last year.
True, but it is still a bleeding wound on the income statement.
Right. And evaluating those losing segments requires looking a bit deeper.
Yeah, you have to look beyond the raw profit and loss statement and understand corporate strategy here. Like, the drop in the trading segment suggests a deliberate pivot away from low-margin third-party distribution.
Because they don't own those brands.
Exactly. When you are dedicating warehouse space and logistics bandwidth to other companies' products like Red Bull or Dano, you are essentially acting as a glorified middleman.
Right.
If the margins on those products tighten, or if the brand owners change their distribution terms, the revenue evaporates quickly. Shrinking that segment might actually be a very disciplined choice to free up resources for their highly profitable powdered milk operation.
Okay, I buy that for the trading segment, but the agriculture segment is where it gets really interesting. And I want to push back a bit here.
Okay, let's hear it.
If I am looking at this strictly as an allocator of capital, the powdered milk segment is printing money with incredible margins. Meanwhile, the agriculture segment, the actual physical farms and cows, is consistently losing money.
Every single year.
Right. So a ruthless private equity manager would look at this and say, cut the farms loose, spin them off, stop the bleeding, and just become a pure powdered milk packing and distribution company. Why tolerate a division that actively destroys capital year after year? Is it just a loss leader?
What's fascinating here is that spinning off the farms would actually destroy the brand equity of their primary revenue driver.
Wait, how?
Well, think about one of the flagship products in that 14.63 billion rupee liquid milk segment. It's Amboella Farm Fresh Milk. You cannot market a premium product based on a specific geographic origin without controlling the physical source.
Oh, I see.
Yeah, Lanka Milk Foods owns the Amboella Livestock Company and the Patapola Livestock Company. Those subsidiary farms are entirely subject to biological risks, feed cost volatility, and weather patterns.
So they're incredibly capital intensive and basically impossible to run profitably on paper.
Right, but they are essentially an internal loss leader. They absorb the agricultural risk and financial losses to guarantee a secure, high-quality supply of raw milk for the liquid dairy segment.
So you can't sell farm fresh milk without the actual farm.
Exactly that. It is the price of supply chain sovereignty. If they spun off the farms, they'd have to buy raw milk on the open market. They'd lose quality control, they'd be vulnerable to price shocks from independent farmers, and they would instantly dilute the farm fresh brand authenticity.
Which is the whole reason they command that shelf space in the supermarket to begin with.
Exactly. The agricultural loss is a necessary operational hedge to keep the 14 billion rupee revenue engine running.
Okay, that dynamic explains the income statement perfectly. We've got the high volume of the liquid milk, the high margin of the powder, and the necessary cost of the farms.
All making sense so far.
Right. But when I look at the net asset value per share, the income statement stops making sense.
Here we go.
Yeah. Their net asset value per share jumped from 72.27 to 95.89 rupees in a single year. Now, an operational profit of 2.8 billion rupees is impressive, but it mathematically cannot account for a 23 rupee jump in net asset value across hundreds of millions of shares.
No, it can't.
The math forces us to look at the balance sheet. So what does this all mean? We've been talking about cows and powdered milk, but more than half of their assets are investments.
Yeah, the balance sheet reveals the true architecture of Lanka Milk Foods.
It's crazy.
When you look at their total assets, the figure sits at a massive 46.8 billion rupees. But if you strip away the property, the factories, the equipment, and the cows, the biological assets.
Natural dairy stuff.
Exactly. You are left with a 27.96 billion rupee line item classified simply as other investments.
Well over half of this dairy company's total asset base is parked in investments. Are we looking at a dairy company or a mutual fund that just happens to own some cows on the side?
It really is a fair question.
It's like buying a quiet neighborhood bakery and realizing their real money is in the multi-million-dollar real estate it sits on.
That is a great analogy. And this is where we have to talk about fair value through other comprehensive income, or FVOCI.
Right, because if we look below the standard operational profit line on the income statement, there is a separate section for comprehensive income.
Yeah, and there is a single line item there labeled net change in fair value of equity securities at FVOCI.
And the gain recorded there for the year is 7.04 billion rupees. That pushes their total comprehensive income to a staggering 9.85 billion rupees.
Yeah. To understand why a 7.04 billion rupee gain doesn't just show up in their standard profit margin, we have to look at the accounting rules governing corporate holding structure.
Okay, break that down for me.
So FVOCI is a mechanism used when a company holds long-term strategic equity in other companies. They are not day trading these stocks to generate quarterly cash flow.
Right, they're holding them for long-term capital appreciation and dividend yields.
Exactly. And because the stock market fluctuates wildly, flowing those paper gains or losses through the daily operational profit would make the dairy business look impossibly volatile.
I see. It's like running a local coffee shop, but keeping the shop's excess cash reserves in a high-risk tech index fund.
Yes.
The coffee shop itself operates smoothly, making a steady $50,000 a year selling lattes. But depending on what the stock market does that year, your tech fund might jump by $2 million or crash by $1 million.
And you have to separate those two realities on your books.
Right, because if you mix them together, an investor looking at your profit and loss statement might mistakenly believe you sold $2 million worth of extra coffee.
Or worse, that your coffee business is completely failing because the tech market took a hit.
Exactly. That analogy really clarifies it.
It captures the exact intent of the accounting standard. FVOCI isolates the operational performance from the financial market performance. What we're seeing here is that the board of Lanka Milk Foods has effectively built a dual-engine corporate structure.
Dual engine, yeah.
They operate this complex, physically demanding dairy supply chain that generated 2.8 billion in profit while simultaneously managing a multi-billion rupee investment portfolio that swelled by 7 billion rupees purely through market appreciation.
Which raises a major question about capital allocation strategy for you, the listener. Because when you are analyzing a historic, asset-rich company, you cannot just project their future value based on their product margins.
No, you really can't.
If you only looked at the price-to-earnings ratio of their dairy operations, you would be entirely mispricing the company. You really are essentially evaluating a multi-billion rupee mutual fund.
It just demonstrates how retained earnings compound over decades. I mean, a company incorporated in 1981 has had over 40 years to generate cash.
And instead of returning all that excess cash to shareholders or reinvesting it into the low-margin agricultural side, the board chose to allocate it into equity markets.
Right. They built a parallel wealth engine that now aggressively pads their overall corporate valuation.
But if the board is making capital allocation decisions that result in a 27 billion rupee investment portfolio, we kind of have to ask who is actually sitting at the table making those calls.
Yeah, this raises an important question about corporate governance.
All right. Who has the power to decide whether to buy more dairy farms or buy more equities? Because looking at the top 25 shareholders, the public is largely just a passenger.
Absolutely. Two corporate names really dominate the register. Milford Exports, Ceylon, PVT Limited, holds 33.57% of the shares, and Melstacorp PLC holds 32.59%.
So together, those two corporate entities command an over 66% supermajority over Lanka Milk Foods.
Yeah, and a supermajority ownership structure fundamentally alters the nature of the public shares.
Because the public holds what, roughly 33.83% of the company?
Right, spread across 11,021 individual shareholders. In practical terms, those 11,000 retail investors have zero leverage.
With two giants owning over 65%, does the average public shareholder actually have any voice at the table?
Short answer, no. They cannot force a board seat, they cannot demand a special dividend, and they cannot alter the capital allocation strategy. They are minority participants, betting entirely on the competence and alignment of Milford Exports and Melstacorp.
Or they're just along for the ride, hoping these two giants keep paying out a dividend. Which, to be fair, the market clearly validated the strategy of those majority holders this year.
Oh, definitely. The share price surged.
Yeah, it ended the quarter at 80.10 rupees, nearly doubling the 43.4 rupees from the previous year, and hitting a high of 96.7 at one point.
That's massive growth.
And they also declared an interim dividend of 1.00 rupee per share in February 2026. With nearly 400 million shares outstanding, they distributed roughly 400 million rupees. But I don't know, I look at that 400 million rupee dividend against a 7 billion rupee comprehensive income gain.
And it feels a bit small.
Yeah, it feels like the minority shareholders are just receiving a modest allowance to keep quiet while the two giants consolidate the real wealth.
Well, the dividend is essentially the yield paid to maintain the stability of the capital structure. While minority shareholders sacrifice control, they do gain institutional stability.
Explain that a bit more.
Sure. A stock with a 66% institutional lockup has a very small free float, which is the number of shares actively traded on the open market. This generally reduces the day-to-day volatility of the share price compared to a company entirely owned by retail day traders.
Because the majority owners have an existential interest in the long-term survival of the asset, rather than just flipping the stock for a quick quarterly gain.
Exactly. And that institutional bedrock is vital, especially during periods of corporate vulnerability. For instance, the financial statements note that the former chairman, Mr. DHS Jayawardena, passed away in February 2025.
Oh, okay.
And the company is now being navigated by Executive Chairman C.R. Jans. Leadership transitions in historic, family-founded or tightly controlled companies can often trigger panic selling or aggressive, hostile takeover attempts.
Right, the market hates uncertainty.
Exactly. So when two aligned corporate entities hold 66% of the voting power, it completely insulates the company from external market turbulence during the transition. The public might be strapped into the passenger seat, but they are riding in an armored vehicle.
Wow, riding in an armored vehicle. That's a great way to put it. It is a fascinating trade-off between control and continuity.
It really is.
So let's trace the arc of what we've uncovered in these 20 pages for you, the listener. We started by looking at a dairy company executing a brilliant operational leverage play, tripling their profit on a 14% revenue increase.
Right.
We dug into the segments and found a complex web of cross-subsidization, where high-margin powdered milk and massive liquid dairy volumes actively fund the capital-intensive, loss-making farms.
Farms that are required to maintain brand authenticity.
Exactly. And then we followed the math past the operational limits and into the balance sheet, revealing a 27 billion rupee parallel investment vehicle.
Yeah, we saw how fair value through other comprehensive income shields the daily dairy operations from stock market volatility, while quietly compounding the true net asset value of the firm.
All under the direction of a supermajority ownership structure. The ultimate lesson here for you is to never take the product on the shelf as the full reality of the business.
Absolutely. Whether you are analyzing a stock, researching a competitor, or negotiating with a supplier, the physical product is just the tip of the spear.
You have to read the segment breakdown to find out where the actual cash flow is generated, and you must interrogate the balance sheet to understand how the board is allocating that capital.
Financial statements strip away the narrative and show you the underlying physics of the corporation. The real wealth of an established company rarely lives entirely in its core operations.
I want to leave you with a final thought to mull over. We saw that Lanka Milk Foods generated a 7.04 billion rupee gain from their investment portfolio this year, completely dwarfing the 2.8 billion in operating profit from their actual dairy business.
It's a huge difference.
Yeah, and we established that this is the result of decades of retained earnings. But it raises a philosophical question about the life cycle of successful corporations. If a company's side investments consistently outperform its core operational business by billions of rupees year after year, at what point does the original founding mission become a distraction? If you are making more wealth trading equities than you are managing pastures, when does a dairy business become just a very complex, very expensive side hustle? Think about how many legacy brands might actually just be hedge funds in disguise. Keep diving deep.